ETFs aren't magic. They're a simple, proven path to growing money over years without hard choices. In this video, we break down a straightforward, repeatable way to invest in ETFs for beginners. We'll keep it practical and give you steps you can use this month. ETFs let you own a slice of many companies with one purchase. They spread risk and costs, so you don't have to pick a few winners to beat the market. Before you buy anything, ask yourself why you're investing. The goal guides everything that follows. How long you have before you need the money matters too. The next piece is the simplest core idea, a mix of stock ETFs for growth and a bond ETF for stability. For many beginners, a 3-ETF core works well. We'll walk through a concrete example you can copy. The plan uses US stock, international stock, and a bond fund. A common starting mix is 40% US total stock, 20% international, and 40% bonds. Why these numbers? It's a balance between growth and safety. Stocks do most of the heavy lifting over time, while bonds help soften the ride when stocks wobble. If you want less risk, you can tilt toward more bonds and fewer stocks. A gentler version would be 60% in US stock and 40% in bonds, and you could reduce or remove the international piece. The key is to start with a plan you can stick to. Step 1 is setting up your account. You'll need a brokerage to buy and hold ETFs. Look for a platform with low fees, a friendly mobile app, and reliable customer service. Next, pick your funds. For beginners, 3 widely used ETFs work well as a core. US Total Stock Market ETF, for example, VTI. International Stock ETF, for example, VXUS. Broad Bond ETF, for example, BND. These tickers are examples, but the idea is to choose broad, diversified funds with low costs. When you compare funds, cost matters. Look for low expense ratios and minimal trading fees. A difference of a few tenths of a percent compounds to a lot of money over decades. The goal is to keep costs as small as possible while still getting broad exposure. With the 3 ETFs in mind, you can set a simple allocation. A practical default is 40% US stock, 20% international stock, and 40% bonds. That puts a strong emphasis on growth, but with a cushion from bonds. If you prefer a more growth-focused approach, you could try 50% US stock, 30% international, and 20% bonds. If you want a more conservative start, try 30% US stock, 10% international, and 60% bonds. No matter what, start with a number you are comfortable with. Step 3 is to fund regularly. Set up automatic monthly contributions. By contributing every month, you time the market less and build discipline. The exact amount is up to you, but the habit matters more than the size of the first few deposits. Step 4 is to automate rebalancing. Rebalancing keeps your actual investments near your target mix. Do it at least once a year, and more often if you feel comfortable. A simple rule: if any part drifts beyond 5 percentage points from your target, rebalance back to target. How do you rebalance? Sell a small amount of the part that's high and buy more of the part that's low until you return to your target. It sounds small, but it preserves your risk level over time. Keep costs in mind as you rebalance. If you're charged for trades, you may want to rebalance less often or combine moves into a single year. Some brokers offer automatic rebalancing tools. If yours does, they can simplify the process. Step 5 is to stay focused on long-term goals. The market will swing up and down. The plan is not to chase the peaks or dodge the dips every day. You're investing for years, not weeks. A quick note on accounts. In many places, you can put these ETFs into tax-advantaged accounts first. In the US, that could mean an IRA or a 401k. In other countries, look for the best tax-advantaged space available. The idea is to let compounding work with as little tax drag as possible. Now, a practical day-to-day approach. Treat this like a routine, not a quiz you must ace. Set a calendar reminder for quarterly checks. During those checks, confirm your automatic contributions are still going in and your allocations are still in line with your targets. A few common mistakes to avoid. Don't try to time the market by swapping in and out of ETFs based on headlines. Don't ignore the gap between your plan and your actual behavior. If you miss a month, adjust rather than giving up. Don't chase hot sectors or trendy themes. The beauty of ETFs is broad diversification with minimal fuss. If you're worried about a market drop, remember 2 ideas. First, you're investing for the long run. Second, a well-structured mix dampens some of the worst swings. Bonds behave differently from stocks and can help the overall portfolio hold steady when stocks fall. A simple habit to develop is to automate not only contributions, but also education. Spend 10 minutes once a week reading one short article or watching one brief explainer about ETFs. The goal isn't to become an expert overnight, but to build a steady understanding you can rely on when you review your plan. What if you already have a bit of money saved and want to start right away? Open a brokerage, pick your 3 ETFs, set the allocations, and set up automatic monthly contributions. After a few months, you'll see the balance grow and the calendar reminding you to rebalance at year-end. If you're unsure about any step, start small. A mini version with smaller amounts still uses the same plan. The key is to begin, build the habit, and adjust as your situation changes. Here's a quick recap of the actionable parts you can apply today. Define your goal and time horizon to guide risk. Build a core 3 ETF mix: U.S. stock, international stock, and bonds. Use allocations like 40% U.S. stock, 20% international, 40% bonds as a starting point. Choose broad, low-cost funds and keep expense ratios in check. Set up automatic monthly contributions to build momentum. Rebalance at least once a year, or when any piece drifts by about 5 percentage points. Use tax-advantaged accounts where available to boost compounding. Stay the course and avoid chasing market fads. If you want a quick mindset shift, think about investing as a habit, not a race. Your future self will thank you for the steady, simple choices you make today. As you grow more confident, you can customize your plan. Some people add a small slice of a dividend-focused ETF or a small-cap ETF for extra tilt. Others expand the bond sleeve to include international bonds for broader diversification. The core principle remains the same: low costs, broad exposure, and consistent investing. If you're starting from scratch, this approach gives you a clear, disciplined path. It reduces guesswork and keeps you in the driver's seat without needing a finance degree. It's a practical way to begin building wealth through ETFs, even if you're juggling bills and a busy life. Finally, remember that every investor starts somewhere. Small steps done consistently beat big moves made sporadically. The plan you begin with is more important than the exact funds you choose today. If you found this helpful, please like the video, subscribe to the channel, and leave a comment with your question or the topic you'd like to see next.